Onto your markets now. Asian markets were mixed today. This followed Wall Street's major indexes making gains following 2 days of serious sell-offs. And while there's been some improvement, market players remain focused on next week when the US Fed Reserve will make its call on interest rates, the expectation being anything between a 75 and 100 basis point increase. Japan's Nikkei share average rose by 0.21%. The Hang Seng Index edged up by 0.44%, while the Shanghai Composite declined by 1.16%. Over in the United States, Wall Street stocks closed higher on Wednesday as an on-target inflation report largely stopped the flow of Tuesday's sell-off. PPI data came in close to consensus estimates and offered some reassurance that inflation is indeed on a slow downward trajectory. All three indexes wavered throughout the day but ultimately ended the day in positive territory. They all failed to regain meaningful ground lost in Tuesday's carnage. The S&P 500 gained 0.34%. The Nasdaq Composite gained 0.74%, while the Dow Jones Industrial Average rose by 0.097%. While the local all-share index is trading in positive territory with a broad-based improvement in stocks, financials, however, are leading the charge, up over 1 percentage point on last viewing. Positive annual results from financial services group FirstRand may have spurred sentiment on the day. On the currency front, unfortunately, the rand is losing steam, trading around 17.50 against the US dollar. Meanwhile, Brent crude oil has lost steam, and no doubt due to the dollar's strength, the price of gold is also falling. Well, to unpack the markets for us, I'm joined by Han Ten. He's the Chief Market Analyst at Xinity. Very good afternoon, Han. Thank you very much for joining us. So it seems like equity markets are trying to rebound after significant falls in the past days. But of course, the Fed Reserve's upcoming meeting continues to preoccupy market players. What's your sense?
Yeah, I think overall risk assets, and that includes stocks, those are set to find it hard to climb or, as you rightly pointed out earlier, recover meaningfully as long as the prospects of more Fed rate hikes are in the pipeline, right? And given what we know earlier from this week, as you mentioned earlier, you've got this higher than expected US inflation print. So that suggests that the Fed has got more rate hikes, more to do in order to combat that multi-decade high inflation. So I think in the interim, that should translate into a stronger dollar environment, but also perhaps a stronger ceiling for stocks and other risk assets.
So what's happening in Japan? I mean, I understand that the yen is on a downward trend. So why doesn't the central bank there simply increase interest rates like other major banks to help strengthen the yen? Or is that too simplistic an analysis?
Actually, that's a very excellent question, and I'll try to unpack that question in a succinct answer. So it all boils down to how the Bank of Japan views inflation, right? So while other central banks like the Fed, the ECB, the Bank of England, they think that this inflation is sticking and they need to really push it down, the Bank of Japan thinks that this will pass. So keep in mind that for many years now, Japan has had a deflation problem. So with the numbers that they're seeing now, positive numbers, they think this is as good a shot as they can to try and get healthy inflation embedded into the economy. That's why they are keeping their yields, their bond yields lower, but that in turn is actually leading to a weakening yen, at least compared to the rising US yields and US dollar.
Complicated. So emerging markets in South Africa, like South Africa, for example, always experience pain when international market volatility hits. Do you expect that to continue, in terms of us seeing weaker currencies and, of course, then having to import higher inflation as well?
Yeah, so the short answer is, again, yes. I do expect more near-term pain for, at least via the currency channel, until markets really get a handle as to how high the Fed will send US interest rates in the interim, and as long as those expectations continue moving higher, that should translate into a stronger US dollar, and at the same time, more weakness potentially for emerging market currencies. Although, to be fair, I think what we've seen in recent decades is that emerging economies have learned their lessons from the past and are in a much healthier position, at least in terms of their foreign reserves, in order to defend their currencies. So while they are in a healthier state now, I think for the short term, though, we can expect more weakness for emerging market currencies.
So do you think that major central banks are going to be able to get the balance right when it comes to pushing up higher interest rates in terms of ensuring that economies don't go into a recession? And what does the current situation mean right now for the commodities picture? Because we do see that there's been some weakness, particularly on major commodities like oil and obviously gold, as well as the US dollar strengthens. And very specifically here for South Africa, we're a mineral exporting country. What's the trajectory for commodities?
Right. So let me address the first part of the question first. I think that's a very delicate act, a near impossible task of central banks trying to find a sweet spot between, on one hand, subduing red hot inflation, but on the other hand, not causing too much economic pain. My stance is that I think the central banks will favor mandate to quell those inflation pressures at the expense of the economy. In other words, they are willing to tolerate more economic pain so that they can keep inflation in check. That's my stance. Now, what does that mean for oil prices? Obviously, we are seeing oil been falling because of the fears of a recession, right? Interest rate hikes tend to kill or destroy some of the demand for oil, and that should bring prices lower. But I think given what we've heard from OPEC Plus recently, they are willing to now step in, or at least signaling that they are willing to step in and defend prices. So there's a supportive element there. For gold prices in particular, again, it all boils down to how much higher the Fed can send US interest rates. The higher US interest rates go, the stronger the dollar. The stronger the dollar, the lower gold prices should.
All right, Han, we're going to leave it there, but thank you very much for your time and giving us your angle on what's happening in the markets. That was Han Ten. He's the Chief Market Analyst at Exinity. We're going to go for a quick break. Thereafter, we'll have an interview with the CEO of FNB.